Warren Buffett just sold half of his Apple stake. Jeff Bezos dumped $4 billion in Amazon stock. Bill Gates has been quietly liquidating Microsoft shares for months. And right now, as you're watching this, the world's wealthiest individuals are making moves that should terrify anyone who thinks the markets will keep climbing forever. Because when billionaires start selling everything, they're not just taking profits. They're positioning for something catastrophic that the rest of us can't see coming yet. There's a pattern here that repeats before every major crash. A sequence of 3 specific trades that ultra-wealthy investors make when they know the party's about to end. And if you understand these trades, if you can recognize them happening in real time, you can protect yourself before the crowd realizes what's coming. But here's what makes this moment different. These 3 trades aren't just happening individually. They're happening simultaneously across every major market, in every sector, by every category of sophisticated investor. That's never happened before. Not in 2008, not in 2000, not even in 1929. This isn't about market timing or getting lucky with a single stock pick. This is about understanding how the smartest money in the world thinks, how they prepare for disasters that ordinary investors never see coming, and why their current behavior suggests we're closer to a crash than anyone wants to admit. Because when people who have billions to lose start acting like the end is near, maybe it's time to pay attention. Let me show you exactly what they're doing, why they're doing it now, and how you can use their playbook to position yourself before everyone else figures out what's happening. The first trade happens when billionaires sense instability, but before the broader market shows any obvious signs of trouble. It's called the liquidity grab, and it's exactly what it sounds like. They convert complex investments into cash, but not the way you'd expect. Warren Buffett didn't just sell Apple because he thought the stock was overvalued. He sold it because he needed liquid capital positioned for opportunities that only appear during chaos. When markets collapse, the best assets become available at massive discounts, but only to investors with cash ready to deploy immediately. Buffett now holds over $325 billion in cash and short-term treasuries. That's not defensive positioning, that's ammunition. But Buffett isn't alone. Ray Dalio has been reducing equity exposure across Bridgewater Associates. Carl Icahn has been liquidating positions he's held for years. Paul Tudor Jones has moved heavily into cash and government bonds. These aren't random decisions by unrelated investors. They're coordinated responses to signals that retail investors don't even know exist. The liquidity grab works because sophisticated investors have access to information flows that ordinary people never see. They attend private economic briefings. They have direct relationships with Federal Reserve officials. They know which companies are struggling with debt refinancing before earnings reports reveal the problems. When they start converting to cash simultaneously, it's because their collective intelligence network is flashing red. Here's why this matters for you. When billionaires grab liquidity, they create temporary selling pressure that actually keeps markets elevated. Their sales are absorbed by pension funds, mutual funds, and retail investors who think they're getting deals. But this creates a false sense of stability. The market looks healthy on the surface, while the smartest money is quietly heading for the exits. The second trade is more subtle but infinitely more dangerous. It's called the hedge flip, and it reveals just how sophisticated these investors really are. Instead of just selling stocks and holding cash, they start building positions that profit from volatility and decline, but they do it in ways that are almost invisible to market observers. Take George Soros, who's been quietly building massive short positions through complex derivative structures. These aren't the kind of shorts that show up in public filings. They're hidden in swap agreements, collar trades, and option strategies that only become visible after the damage is done. Bill Ackman has been doing the same thing, using credit default swaps to bet against corporate debt while maintaining long equity positions in other sectors. This is financial warfare at the highest level. They're not just protecting their wealth, they're positioning to profit enormously when the crash comes. And the beauty of the hedge flip is that it allows them to maintain public optimism while privately preparing for disaster. Ackman can go on television talking about great investment opportunities, while simultaneously betting billions that corporate America is about to implode. The hedge flip works because markets always overshoot in both directions. When confidence collapses, assets don't just fall to fair value, they fall below fair value as panic selling takes over. Billionaires who position correctly can make more money in 6 months of crash than they made in 5 years of bull market. That's why they're willing to sacrifice current returns for future positioning. But here's what makes the hedge flip truly dangerous for everyone else. When sophisticated investors start betting against the market while publicly remaining optimistic, they create a liquidity trap. Retail investors keep buying based on public statements, while smart money builds short positions. This creates artificial demand that keeps prices elevated right up until the moment the trap springs shut. The third trade is the most telling of all. It's called the safe harbor rotation. And when you see it happening across multiple billionaires simultaneously, you know the timeline has accelerated. This is when they move from cash into assets that not only preserve wealth during chaos, but actually increase in value when everything else collapses. Gold is the obvious choice, and billionaire buying has pushed precious metals to levels not seen since the last crisis. But the sophisticated money isn't just buying gold. They're buying farmland, rare earth minerals, water rights, and energy infrastructure. Assets that produce necessities regardless of what happens to financial markets. Ray Dalio has been vocal about this strategy, calling it the paradigm shift portfolio. He's moving away from traditional financial assets toward real assets that maintain value when currencies debase and governments default. Other billionaires are following the same playbook, but staying quiet about it. They don't want to trigger the very panic that would validate their positioning. The safe harbor rotation is happening because billionaires understand something that most investors miss. The next crash won't just be a market correction, it'll be a currency crisis, a debt crisis, and a confidence crisis all rolled into one. When that happens, traditional safe havens like government bonds and bank deposits become liabilities, not assets. But here's the most important part. These three trades work in sequence, and each one amplifies the next. The liquidity grab creates the cash needed for the hedge flip. The hedge flip generates the returns needed for the safe harbor rotation. And the safe harbor rotation provides protection when the entire financial system comes under stress. Right now, we're seeing all three trades happening simultaneously across the billionaire class. That's unprecedented. Usually these strategies unfold over months or years as different investors reach the same conclusions at different times. But in 2024, they're all moving together, all positioning for the same outcome, all preparing for the same timeline. What makes this moment uniquely dangerous is that their collective actions are creating the very instability they're protecting against. When enough smart money heads for the exits, when enough sophisticated investors start betting against the system, when enough billionaires rotate into safe harbors, the market structure itself becomes fragile. We're not just watching individual investors make defensive moves. We're watching the systematic withdrawal of smart money from traditional markets. And when that withdrawal reaches critical mass, when the selling pressure becomes too obvious to ignore, that's when the broader market finally realizes what's been happening behind the scenes. The crash doesn't come from external events. It comes from the collective realization that the people with the most to lose have already positioned themselves for the worst-case scenario. And if they're right about what's coming, then everything changes very quickly. Quickly. The timeline isn't theoretical anymore. When you track the specific moves these billionaires are making, when you map their trades against historical patterns, you discover something that should make your blood run cold. Every single crash in modern history was preceded by this exact sequence. Smart money exits, hedge positions build, safe harbor assets accumulate, and then the dominoes start falling. But there's a fourth element happening now that didn't exist in previous crashes: digital coordination. Today's billionaires don't just share information at private dinners and exclusive conferences. They have real-time communication networks that allow them to coordinate moves instantly across global markets. When one major player identifies a threat, that information spreads through their network faster than any retail investor could react. This creates something economists call cascade amplification. One billionaire's defensive move triggers similar moves from their network, which triggers moves from their networks, until the entire ultra-wealthy ecosystem is moving in lockstep. What used to take months now happens in days. What used to happen gradually now happens all at once. Think about what this means practically. When Warren Buffett sells Apple, it's not just Buffett making that decision. It's Buffett responding to intelligence that's flowing through networks you and I will never access. When Bill Gates dumps Microsoft, he's not just protecting his own wealth, he's acting on consensus analysis from the most sophisticated investors on the planet. This coordination explains why their timing is so precise. These aren't random defensive moves by paranoid billionaires. These are calculated responses to specific triggers that their collective intelligence network has identified. They know something we don't, and they're acting on that knowledge with surgical precision. Here's where it gets really dangerous for ordinary investors. The same digital networks that allow billionaires to coordinate their exits also allow them to manage market psychology. They can control the narrative around their moves, explaining them as routine portfolio rebalancing or tax optimization, while the real reason remains hidden. When Bezos sells Amazon stock, the official explanation is estate planning. When hedge fund managers reduce equity exposure, they call it risk management. When sovereign wealth funds rotate into commodities, it's described as diversification. But when you see all these moves happening simultaneously, when you track the scale and timing, the pattern becomes unmistakable. They're not managing risk, they're positioning for catastrophe. And they're doing it while maintaining public confidence in the very markets they're quietly abandoning. This creates what behavioral economists call the confidence trap. Retail investors keep buying because public messaging remains optimistic, while smart money executes the largest coordinated exit in financial history. The most terrifying part is how this amplifies systemic risk. In previous crashes, smart money and dumb money were mixed throughout the market structure. When panic hit, there were always sophisticated investors stepping in to provide liquidity at lower prices. But when all the sophisticated money has already exited, when all the billionaires have already positioned defensively, there's nobody left to catch the falling knife. This is why the next crash will be different from anything we've seen before. It won't just be a market correction where some investors lose money and others buy the dip. It'll be a systematic unraveling where everyone except the pre-positioned billionaires gets crushed. Because they're not just protecting their wealth, they're concentrating it. When markets collapse and assets become available at massive discounts, the billionaires who grabbed liquidity early will have the cash to buy everything at fire sale prices. The billionaires who built hedge positions will have the profits to acquire distressed assets. The billionaires who rotated into safe harbors will have the stable wealth base to deploy capital when opportunities emerge. This isn't just about surviving the crash. It's about using the crash to consolidate even more wealth and power. And the mechanism they're using to accomplish this is the same three-trade sequence they've used before every major market collapse in modern history. But here's what you need to understand about timing. These trades don't happen randomly. They follow a specific sequence based on how close the billionaires think we are to the breaking point. The liquidity grab happens first, usually 12 to 18 months before the crash. The hedge flip follows, typically 6 to 12 months out. The safe harbor rotation comes last, usually 3 to 6 months before everything falls apart. Right now, we're seeing all three happening simultaneously. That suggests the timeline has compressed dramatically. Either the crash is much closer than anyone imagines, or the risks are so severe that normal timing considerations no longer apply. Either way, it's not a good sign for anyone who isn't following their playbook. The acceleration also suggests something else. The billionaires aren't just preparing for a normal recession or bear market. They're preparing for something systemic, something that breaks the normal rules of market cycles, something that requires the kind of extreme positioning we're seeing right now. When you combine unprecedented debt levels with algorithmic trading, when you add geopolitical instability to currency debasement, when you layer demographic collapse onto infrastructure decay, you get the kind of perfect storm that requires perfect storm positioning. And that's exactly what we're witnessing. The billionaires aren't just betting against individual stocks or sectors. They're betting against the entire system continuing to function normally. They're positioning for the possibility that the mechanisms we've relied on for decades might simply stop working. And if they're right, if their collective intelligence network has identified something that fundamental, then everyone else is in serious trouble. Because when the system breaks, when the normal rules stop applying, when confidence collapses completely, the only people who survive are the ones who saw it coming and positioned accordingly. Everyone else becomes collateral damage in the wealth transfer, from unprepared to prepared, from reactive to proactive, from those who trusted the system to those who understood its fragility, illity. So what does this mean for you? The writing is on the wall, written in trades worth hundreds of billions of dollars. 3 strategies, executed simultaneously by the smartest money in the world, all pointing toward the same conclusion. The crash isn't coming someday. It's already in motion. You have a choice. You can keep believing that this time is different, that markets only go up, that the billionaires are wrong about what they see coming. Or you can learn from their playbook. Build your own liquidity cushion before cash becomes scarce. Consider your own hedge positions before volatility explodes. Rotate into assets that hold value when everything else collapses. The billionaires aren't hoping they're wrong. They're positioning to profit when they're right. And if history is any guide, when this many smart people make this many defensive moves this quickly, they usually are right. The only question is whether you'll be positioned like them when the dominoes start falling. The pattern has played out the same way for over a century. The only difference this time is the speed and the scale. When it hits, it won't give you time to react. Your positioning today determines your outcome tomorrow. Choose wisely.